All right, guys, let's quickly take a look at the week ahead. The week ahead is going to be a lot more exciting this week on the data side, at least, compared to what we've had over the previous 2 weeks. The previous 2 weeks was just very messy, very choppy, lots of price distortions because there was just so many outside risks that the markets was focused on. You know, last week had a lot of weird price distortions with month end and quarter end in the mix. We obviously had the markets also more focused on the political side of things, with risk premiums really being in the driver's seat, especially for the dollar. I mean, if we take a look at that OAT Bund spread, something we've looked at quite a lot over the last few weeks, if we just overlay the dollar once again, you know, the dollar has been mainly driven by the risk premium flows. It's not really been driven by the economic data. Now, to be fair to the dollar, we also really didn't have any major tier one economic data points anyway. You know, I won't really classify PCE as being a tier one event. So we didn't really have those big, punchy, massive events anyway for the dollar to be focused on. But even the ones that we did have, the markets were pretty quick to discount those and just trade in line with the risk premiums. This week, you know, with the French election yesterday not really providing the markets with any real surprises, I do think that it's going to be easier for the dollar in a week like this to focus on the data again, especially since it's, you know, some of the earlier fears are not as big as they were just going back to Friday. And secondly, because these are actually tier one events that we'll be getting this week. Now, we start off the week strong with the ISM manufacturing coming up a little bit later today, and we have the services print coming up as well on Wednesday. Here we go, on the 3rd. So these two very important indicators. You know, markets normally sees these as very important leading indicators for the US economy. However, it's important to understand that the relationship between leading and coincident and lagging indicators has not exactly been great, to say the least, over the course of the last 12 months. You know, we've seen that continued divergence between the hard data and the soft data, especially going back to last year. And, you know, it's all been down to how the economy has changed after COVID, right? There's been big dislocations in how things work and how they work now, you know, looking at the labor market and what type of influence the work from home aspect has had on so many different parts of the economy. It's been strange because the leading indicators, the soft data, like your ISMs, for example, they just haven't been the type of leading indicators that we are used to them being. You know, we had a lot of softness portrayed by the soft data last year, for example, but the hard data, looking at things like GDP, retail sales, the actual numbers, continue to impress. And they've only really started to slow down more recently, the hard data. And now as they are slowing down, now we are starting to see the soft data improve a little bit. So just keep in mind that when we trade these or look at these in a week like this, it's not really going to be down to necessarily what they mean for the macro part of the economy. It will to some degree, but the markets are cautious of these prints because they haven't exactly been the best leading indicators, at least in the last, let's just call it 12 to 18 months. So that's just worth keeping in mind when we look at prints like this, like the ISM. Now, when we take a quick peek here at the ISM manufacturing print, the manufacturing one, we had that's another divergence that we've had over the course of the last couple of months now, where the manufacturing and the service economy just hasn't given us the same signals, right? If we take a quick look here at the manufacturing print that we had last time around, we had an overall disappointing print because we had prices paid pushing lower, we had the headline index pushing lower, new orders pushing lower. It was really only employment that saw a pop to the upside, moving back into expansionary territory. So overall, it was more of a negative print. But then if you compare that to services had the opposite. Services jolted higher in terms of business activity, in terms of new orders, the headline index. We even had employment tick up, not as big as we saw with the manufacturing. But bottom line is everything mainly ticked up and showed some further, you know, expansionary environment here for the services economy. So it'll be very interesting, firstly, to see whether these dynamics have changed. You know, are we going to start seeing manufacturing following suit with services, or are we going to start seeing services following more suit with manufacturing? Or are we just once again going to see a weird divergence where one of them comes in really bad, the other one comes in really good? Obviously, only time will tell, but these ones will be important. And like I said, I think the data the dollar will be more sensitive to the data. I think the dollar could be more tradable this week on the data. especially more important data points like this, as opposed to things that we've seen over the last 2 weeks. So definitely one that can create some directional volatility, and definitely ones worth paying attention to. This one today, and obviously the services PMI coming up on Wednesday as well. Now, tomorrow we've got only really 2 events to focus on. The first one, let's quickly touch on the European data first. Not expecting that to be a big market mover on the Eurozone CPI data. Why? Firstly, if we had huge surprises, it could have been tradable, but the markets was too focused last week on the French elections to worry about the Italian and the Spanish and the French data. This week we've had the German data coming out a little bit earlier, the regional prints, and they came in pretty mixed, mostly lower. So that just feeds into the other data that we've had last week, where French data surprised a little bit lower. We had Spanish data coming in lower. Now we're seeing the German data coming in lower. So there's a high probability we see the flash Eurozone total number, HICP, coming in lower as well. Will that really be a focus point for the market? I don't think so. It's all about, it's really all about the risk premiums and the reduction in those risk premiums after yesterday. And I think that'll probably be the main driver for the euro this week, as opposed to these data points. So not really focused on those Eurozone flash HICP data coming up tomorrow. The main events then for us to watch tomorrow will be US JOLTS job openings, and ahead of that we have Fed Chair Powell. Now, Fed Chair Powell is not talking. He's actually in. It's actually an ECB forum that he's talking at. He's basically on the panel there. So I'm not sure what we'll be getting from him on the back of that. If he does talk about policy, if he does talk about the recent data that we've had, maybe PCE, I suppose that could maybe be market moving, but I'm just not expecting him to come out in an ECB forum, suddenly giving us massive new insights, massive new surprises, massive new information that we haven't heard from already. So I've seen a lot of people freaking out about him talking, but I just don't think it's going to be that important for the markets, to be honest. The one that we're more excited about will be the JOLTS job openings. Now, JOLTS has been such an interesting data point to watch over the course of the last few months, because, normally JOLTS just wasn't something that we really paid attention to in previous cycles. It was one of those data points where we just ignored it. But the markets have been kind of infatuated with this data point over the course of the last few months. And I won't expect that to change coming into a week like this, right? There's a lot of focus right now, a lot of question marks about the labor market and about growth, where both of them are headed in the months ahead. So they will be focused on this, and it could well be tradable going into tomorrow's session. Now, what we had last time around was a little bit of a weird divergence between quits and openings, where openings saw a very big drop to the downside, going back to 8 million. But at the same time, we actually saw quits accelerate. Now, that took out some of the oomph of the miss that we had in openings, because obviously, even if job openings are falling, if people have enough confidence to quit their jobs, thinking that it'll be very easy for them to get another, then that does take some of the sting out of the drop that we've had in job openings. So in a week like this, I suppose that the clearest picture that we will be able to get is if both of these things move higher or both of them move lower at the same time. So that's something definitely worth paying attention to, especially with NFP coming up on Friday. This one can definitely create some short-term volatility that we might be able to take advantage of. Then turning our attention to Wednesday. Now, because Thursday is a bank holiday in the US, we actually get our claims data a day ahead of time. So we'll be getting our US initial claims data. Where is Thursday? Where's Wednesday? Here we go. We'll be getting our initial claims data on Wednesday, as opposed to the normal Thursday that we get it in. So just keep that in mind. Now, it's going to be a busy one on Wednesday, because we start off with the Challenger layoffs. We start off with ADP. Both of these feeds into NFP, which is really the only reason why markets focus on them. They are normally not very tradable, especially the ADP. The ADP has been a hit and miss in terms of volatility. I will definitely not be trading that in Wednesday's session. In terms of initial jobless claims, this one can be a little bit more interesting, but only, as we've said recently, in the last 2 or 3 weeks or so. Let me just quickly go to that chart. It's only going to be interesting if we can see these massive key levels being breached, right? If we can see 258 and 261, if we can see initial jobless claims piercing above those levels, that'll start kicking in some real fears about the labor market. Unless we see those numbers, or worse than that, remember the higher this goes, the worse it is. Unless we see those types of really bad numbers, that big type of acceleration in jobless claims, I just don't see that print mattering much like we've seen over the last 3 weeks. So we'll need to see a big number there to get us excited about trading that on Wednesday, especially since we have that coming up ahead of the ISM services PMI. So this thing needs to be massive to get us excited about trading this ahead of this, right? Now, we spoke about the services PMI. Again, we'll have a full preview available for that on the session, but it will be important just as the manufacturing print will be important today. Now, on Thursday, it's going to be a little bit of a tricky one on Thursday because we've got the US away, as you guys know, for a bank holiday. So that means thinner liquidity. It means lower volumes, which can either mean very slow and muted price action, or it can mean exacerbated flows if we do get some unexpected things hitting the wires. Now, we've got two events that could well be worth trading. The first one will be the Swiss CPI coming up nice and early. And then obviously on Thursday, we also have the UK election taking place. Now, let's talk about the election first. Right now, a Labour victory looks to be a done deal, and the markets have stayed very calm about that. I do personally think, though, that once the election is out of the way, that'll allow the markets to focus on the more important things like the Bank of England and the market's view on the Bank of England, especially the recent data as well. The recent data, in my opinion, does not support sterling trading at the current levels where we're seeing the currency trade at. I mean, if we take a look at the currency index here for sterling, now this is looking at a geometric index, we are still trading at some pretty punchy levels. And it's not just looking at, something like a geometric index. Even if you look at something like a real effective exchange rate, differential or a normalized measure, tracking it against other currencies. I actually have that on the screen. Let me just open that up for you guys to show you what I'm looking at here. Even when you track it and adjust for inflation, which a lot of people have blamed for the outperformance, even when you do that, sterling is trading at some pretty high levels. That's the thick orange line that we can see here. So real effective exchange rate suggests that, wow, there's been a lot of good news priced in for sterling. At the same time that we see that happening, we've also seen the City Economic Surprise Index, again looking at a normalized measure, trading at some pretty high levels here, which does suggest that maybe the economist community, might be starting to herd a little bit more towards the upside of expectations, which means there's a higher probability for downside surprises in the economic data. And I mean, if you take a look at the recent services PMI, the downward revision just today that we've had in the manufacturing PMI, let me just show you guys there, for that manufacturing print, it does suggest that maybe we are heading closer towards that area. So that also poses some downside risk for sterling. So I do think that, after the election risks on Thursday is out of the way, I do think it'll open up it'll allow the markets to just focus on what's really important. And on that front, I think there's going to be some downside risks playing out for sterling, but I will touch on that in a separate video. Apart from that, what's going to be more interesting and more exciting on Thursday will definitely be the Swiss CPI data coming up. Now, the SNB had a very interesting prior meeting, as you guys know. Their previous decision was very strange. I mean, they flipped-flopped between the currency being too weak and the currency being too strong, literally in 2 weeks' time. You guys remember back on the 30th of May, we had Governor Jordan coming out talking about, the risks of a higher neutral rate in the medium term, saying that if that should happen, it's going to be down to a weaker Swiss franc. They even stopped their expansion of foreign currency reserves, basically showing us that, hey, we've reached a level where we don't want to see a weaker Swiss franc right now. Literally 2 weeks later, 2 weeks later, they are cutting interest rates and they are stressing or highlighting the risks of a stronger currency and its influence on inflation. I'm like, what? Just make up your mind. Do you think it's too strong? Do you think it's too weak? It's been a real confusing one. I think based on their decision, and obviously based on the price action that we've had in the Swiss franc after their interest rate cut, I do think that the best case scenario for a trade this week will probably come from a massive miss. Something that we see 1.2 or maybe maybe even a number below 1% could be interesting. I just think that feeds into their decision a lot easier, right? If we see a big miss coming out, it'll feed into their concerns about a stronger currency. I just think that's going to be an easier one to trade. Whereas if we get a massive beat, how will that complicate things for them and for the Swiss franc? Will they then start targeting a stronger currency again? After just complaining about a too strong currency just 2 weeks ago. I don't know. I just think a beat's going to be confusing. It's going to be confusing for their recent decision. They literally just cut rates. If inflation starts massively surprising to the upside, I don't know what they're going to do. What their decision did provide us with, though, as we discussed at the time, was potentially a little bit of insights into their threshold for what they would deem as a too strong and a too weak currency. Obviously, versus the euro, it's very important for them from an import-export point of view. And we had the comments about a too weak currency coming up at about 98.60 for the euro Swiss franc, and their complaints about a too strong currency coming in at about that 95 level. So that's basically the threshold, meaning that, we probably should only start worrying about a too weak Swiss franc when we get over here. We probably only have to worry about a very, too strong Swiss franc when we get to these types of levels. So in between that, it's probably tradable, but I don't know. I think the easiest way to trade that will be a miss. It'll just feed into what they said a lot easier. If it's a beat, it's just going to complicate the hell out of things. So I don't know whether that's going to be worth trading unless we see that number coming in massively, massively low. Then moving over to Friday, it's obviously the event that everybody will be looking forward to, and that is NFP. Look, if you take a look at the recent data, let me just quickly open this up. The recent data has suggested that the labor market in the US is continuing to slow. If we look at this, it's not rocket science. The numbers, the colors are there for a reason, right? We can clearly see how the labor market has continued to deteriorate, continued to slow. Doesn't mean it's falling off a cliff, just means that it's moderating from some pretty amazing levels. And that is also coinciding with some other things. We're starting to see the same type of trend develop in the consumer tracker, starting to see consumers also decelerating a little bit. So the markets wants to know where the labor market is headed, right? Are we going to see some material upside risk for the unemployment rate, or aren't we? I think a massive miss in NFP will probably be the simpler way to trade this. I think it's going to be the simplest way to trade it, just because that feeds into broader macro expectations right now, I think. Look, don't get me wrong. If we get a massive beat, we had a nice beat last time around, which provided us with a fantastic short-term opportunity to trade. What did we trade on that event for the 7th? I think it was the Aussie, right? I think we traded the Aussie. Let's just see. 7th. Yeah, here we go. So we traded this on the 7th with that massive beat that we had. So if we get a big beat in a week like this, just because that's the more complicated one for the macro narrative, doesn't mean it can't be traded, right? If it's a monster beat, we can trade it the exact same way that we did last time around. Maybe just swap out the currency that we'll be trading against it. But I think, from a more medium-term perspective, the easier trade would probably be a miss, especially with some of the things calming down in risk premiums for France right now. I just think a miss will be the simpler way to trade that. It will answer a lot of the question marks that the markets have about the labor market, and it'll also put the market's view of two cuts potentially more back in focus, right? In especially for the Fed, where they just recently, it'll be so perfect, right? Because the Fed just recently said, no, we think we're only going to cut once this year. What can change that? Well, the unemployment rate, right? Unemployment rate going to 4.3 or 4.4 probably sees them cutting more than one cut this year. So I just think that's going to be the simplest way to trade that. But as always, we can trade it both ways, and we will have a preview available for how we can look to do that. The other one that's going to be very interesting will be Canadian jobs data. Look, we know the BOC cut rates last time around, and they say that more cuts are coming should inflation drift, back to continue to slow. Now, we didn't get that with the last CPI print. You guys remember that we saw a big big beat to the upside across the measures. Now, looking at this at a trending level, it's not a scary number by any means, but their condition to see continued slowdown in inflation was not justified, right? That condition wasn't met with the previous print. We actually saw a decent pop to the upside, especially above market expectations. And the markets have kind of, paid back a little bit on their interest rate expectations for the BOC, but not a lot. And if you consider how massively stretched this currency still is, if you take a look at the Canadian dollar right now, how massively stretched to the downside we still are, I think that the simplest trade that we can ask for on Friday would be a massive beat across the board for the Canadian data. That'll feed into the inflation numbers. It should pare back some of those market expectations for aggressive cuts for the BOC, and that could be good for a mean reversion opportunity. If it's a massive miss, how much more do we expect the markets to price in downside risks for this currency, right? If you consider what's been priced into this already, I'm just not sure whether a miss, whether a short in the CAD would make a lot of sense if we get a miss in the data. I just think that so much bad news is already priced in for it. So preference there would be to see a massive beat feeding into that CPI data, pushing back against rate expectations, and seeing a little bit of a mean reversion pop to the upside for the Canadian dollar. So that's just a quick view at the week ahead. Like I said, a lot more exciting one this week. Let's hope we get some juicy deviations to actually trade from.